Welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It's the 9th of August, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account and our LinkedIn account. At RenMac LLC is our Twitter account. Well, guys, I think I've got a pick for both the president, vice president that we can all get behind. I'm up in Lake Placid, finishing up a vacation, and I just bought this T-shirt, which is Brooks and Eruzione for president 1980. But what a ticket that would be, huh? Reliving the glory days. Neil, how old were you in 1980?
I wasn't born yet.
Yeah.
But I did like the Kurt Russell rendition of Herb Brooks.
He actually played that well.
Huh?
Yeah. He played that well.
Yeah.
My son, they've got the hockey goal. They've got the hockey goal at the Lake Placid Museum. And my son's like, well, it's just an old hockey goal. And I said, that's like saying the crucifix upon which Jesus Christ was crucified is just a piece of wood. I'm like, that has, I actually cannot believe that you're saying that. It's unbelievable. Anyway, let's start talking a little bit about politics. Let's not dwell on it too much because the markets are crazy. Neil, we had some good data yesterday. Steve, letter grade on Kamala Harris's pick for Waltz. I'm surprised it wasn't Shapiro. He seems like a dead ringer, and I'll tell you what, he seems like a guy who's going to have some meaningful aspirations going forward. I think that guy is pretty sharp. What's your letter grade on the Harris pick, and then maybe a little as to what the thinking was there?
Well, I'm going to say a C. I guess where I'm a little confused, because I agree with you in terms of Shapiro being impressive, arguably more so than Harris. Was he really an option for her? In the sense that, was Harris concerned that he would outshine her on the trail? There's some reporting that suggests that may have been one of the concerns. There's also a belief that maybe Shapiro didn't want the job. If you look at the track record, being vice president is not necessarily a great pathway to the presidency, particularly for somebody who has his aspirations like Shapiro. He met with Harris. I'm not sure what he thought of her, but did he really want to be linked to her policies? Did he think that 8 years from now, he'd be more inclined to win the presidency? I don't know, but that's just another way of sort of looking at it. In terms of selection of Waltz, it's an interesting pick in that it delights both progressives and Republicans. I think it sort of was a missed opportunity had she picked somebody like Shapiro to signal that at least she is campaigning as somebody who's going to try to govern as more moderate. I think, at least from the Republican perspective, not only does it create the appearance that she's going to more be beholden to progressives, and this is basically her first big unilateral decision, but also the fact that it preserves the option of winning Pennsylvania. I mean, Trump's pathway, if you look at where he's spending the money and what his pollsters are telling you, it's about winning Pennsylvania and Georgia. If he wins those two states, he wins the 270 votes needed to become president. And people will make the case, and it's true, that vice presidential selections do not usually matter that much, even in their own states. That said, had she picked Harris, he may have moved the percentage 1 or 2%, which isn't very much, but that may have been enough to deliver the state, given that Biden won Pennsylvania in 2020 by just over 1%. So if Harris goes on to lose the presidency and it's because she loses Pennsylvania, I think people will look back on this decision and question it.
Yeah, I was surprised by it, but he's, I mean, if you look at that rally or watch that rally in Pennsylvania, I mean, he was easily the most dynamic of the speakers that was there.
Well, look, if you want to get conspiratorial, I mean, they already, being the Democrats, got rid of Joe Biden because of concerns, and Harris should know about that better than anybody. You fast forward another week or two, is it inconceivable that they would try to abandon Harris and go to Shapiro had he been her number two? I don't know that it's probable, but at this point, I think anything's possible. If you could get the president to step aside, I'm not ruling anything out. She's probably more aware of that than anybody. And she may also recognize that Shapiro's light might shine a little brighter on that stage, which is why she decided to go with Waltz.
Yeah, that'd be amazing. Neil, we had claims this week. I think that I didn't put to bed, certainly, but it certainly was a sigh of relief from the markets, in terms of what they're thinking about the overall economy. How important are claims to you in terms of how you think about the broader impact and its reflection on the economy?
Well, I think it's an interesting sort of discussion because I don't think it's necessarily a healthy thing that the market goes up over 2% on an initial jobless claims report.
Right.
Like that is not normal, okay? And the fact that people are paying that much attention to it should make you question what the outlook is in and of itself, right? I mean, because normally these numbers come out at 8:30 every Thursday with very little fanfare. Now we're sort of we're hanging on to every wiggle and squiggle. Now, when you look at the initial claims report, I mean, it was better because a lot of the kind of one-off factors that were juicing the initial numbers up have been unwinding, right? Whether that's Hurricane Beryl, whether that's auto retooling, but ultimately, when you look at continuing claims, there's this continued sort of slow leaking up of that series, right? It's rising at about 4 to 5% up year over year, and that kind of tells you that even though initial layoffs are low, once you're laid off or unemployed, it's increasingly more challenging to find another job. Like the job finding rate has come down, and so. I just think there's an awful lot of complacency right now when people are analyzing the economy. The unemployment rate, it's going up, but it's for good reasons. It's all supply driven. This is what happens at full employment. Layoffs are low. So people are kind of I understand it. People want to kind of root for the strong economy, but at the end of the day, the trends in this series, unemployment, are not good. Okay, and I'll put it to you this way. I mean, if you look at the Fed's summary of economic projections, okay, the latest cut of that is in June. They release it every quarter. For 2025, this is for 2025, year-end 2025, they have the unemployment rate at 4.2%. They have core inflation at 2.3%. They have the Fed funds rate at 4.1%. So core PCE 2.3, unemployment 4.2, Fed funds 4.1. Okay, we're already through their unemployment forecast over a year ahead of schedule. We're at 4.3 right now. Maybe that goes down to 4.2. Okay, the trend is still up, but we're basically unemployment has been rising more rapidly than they thought. End of discussion. And core inflation over the last 3 months has been 2.3% at an annual rate. So that's why I say, like, I think a reasonable baseline is 100 to 125 basis points worth of rate cuts because we're hitting their economic targets already. And if you think, that the SEP basically says that that's consistent with 4.1% on the Fed funds rate. So I don't understand why there's this sort of like kind of resistance to what needs to be done. I mean, policy is too tight. I don't think that's a particularly controversial thing to say, but yet you have a lot of this kind of like cheerleading, straw manning things like, oh, we're not going into recession. Well, that's beside the point, right? Like, is the economy slowing or not? Because not all slowdowns end in recession, but all recessions start with a slowdown. So to me, it's a fairly like alarming amount of complacency, and I just say, like, I mean, I've been making this point to our clients, and I'll say it now. But like, you had the economy growing over 3% last year. Unemployment rose 0.2%, despite 3% growth. Okay, this year the economy's been growing a little over 2% GDP. Unemployment is up 0.6% over the first 7 months of this year. Now think about the outlook. Is the outlook for growth better or worse?
Right.
It's worse. You have single family homes, new homes sold, not started, down 35% against last year. Single family starts haven't gone down that much. So there's more room for starts to fall. The fact that the labor markets have cooled means incomes have slowed, which is going to take some pressure, some of the momentum or juice out of consumer spending. And you're unlikely to see a large inventory restocking again because demand has been sluggish. You saw global manufacturing kind of take a step back in July. So why would you expect to see inventory investment rising as rapidly as it did in the second quarter? So that takes some of the pressure off of manufacturing, upward momentum out of manufacturing production. So I just think it's a lot of complacency. And, I mean, part of this business, right, guys, is, I mean, look, everyone knows, like, I generally sit on the sunnier side of the mountain, right? But, part of, like, if you're going to advocate or, try to, like, make a call for more rate cuts, some of that is going to mean, like, the economy is not all right? If everything was fine, they wouldn't be cutting. We wouldn't be talking about this. So it's not, there's no upside to just being complacent. I mean, this is not a message to market participants, but this is to the people that are in the institutional kind of halls where these decisions are made, right? The amount of complacency from you guys is frightening. Okay. This is why it's like, oh, how many times did you see, like, economists going out there and being like, oh, the stock market fell. Look, it's back up again, right? Like, so like the stock market doesn't know anything. Well, it's like, oh, Wall Street's freaking out. Main Street is fine. Like, let me think about that. Like, think about it that way. I mean, how did that work out in 2008, right?
Yeah.
I mean, Wall Street was panicking and Main Street didn't want TARP, and then what ended up happening? So it's sort of, it's ridiculous. I mean, I think that's a remarkable level of complacency right now from the people that make these decisions. And that's actually demonstrated in the Fed speak, right? I mean, they're still telling you things are fine, we have time, this and that. And, I mean, the longer the Fed waits, in my mind, the bigger the first move is going to be.
Weren't they slow to raise rates initially, going back to?
Yeah, it's the same song and dance,
It's the
right?
same.
I mean,
it's just part of a pattern, just sort of slow to act. Is that true, or how you see it?
I mean, I just think that there's too much. Sometimes you just have to. I mean, I think for them, there's too much consensus building at times, and sometimes that's good, and a lot of times it could not be. I mean, you just kind of have to do what you think is right and let the chips fall where they may. I get that that's not the ideal way for them to work, but it is what it is. I mean, like things are happening right now in the economy that you didn't expect to happen, like unemployment going up to 4.3%. when you thought it would be at 4.2 by the end of next year. We're already there. So what does that tell you?
The Ministry of Money. So I think that, one of the easiest ways to look at that is just the spread between where the Fed funds are and where the 2-year yield is, right? I mean, the 2-year yield is essentially the reflection of Fed funds out into, a reasonably predicted future. And you're 125 basis points, last I checked, away from that, or that disparity between those two rates. So you've got a non-market rate, which is 125 basis points above what the market's telling you the neutral rate is. So I don't think you have to do much more than that just to understand how tight or how loose the Fed is at any given point in time. Well, certainly from last week, we had a pretty big swoon on Monday. This is, I think, more about the liquidity in the system, which is a reflection of what's happening in Japan and globally, than it is about the economy. So, to your point, with the data, I think the data is still pretty sound as far as it should be reflected for the market overall. The bigger issue is this gradual shift that we're seeing in the liquidity picture, right? We have started to see some widening of credit spreads. So at the margin, we're starting to see some of this liquidity drain away and making that search for the price of money obviously a little higher. What's the carry trade? The carry trade is essentially the ultra low interest rates that we had in Japan were a use of funding, borrowing in Japanese yen to then turn around and put those dollars or whatever that currency is that you're converting it to into higher returning assets. Now, in the textbook models, you would take say a 0% or a 0.5% loan. You turn around and you buy, say, short-term paper with that that might be yielding 2.5%, 3%. Play that spread and hope the currency doesn't depreciate or hedge it out, which obviously has a cost to it. That doesn't always happen. That's what the textbooks say. It's very easy, though, to take your billions of dollars, convert it, make a loan, leverage that up, come back and buy NVIDIA, right? So if we look at what the source of weakness was back last week when this was really coming to a head, it was textbook. It was in the crowded days. The weak market was really a function not of the equal weight S&P, and certainly that was down too, but it was a function really of the pressure that was on the most sensitive and highly held securities. So that's going to happen. I know that's not exactly what the textbooks say, how it should happen when you're arbitraging it. That's called basis risk when you buy different securities and have different, obviously, correlations and sensitivities to other factors. But that's what happens in reality. So I think the question is that done? Have we wiped that out, or is there more to it? I think my biggest concern, and we talked about this back at the beginning of the year, my biggest concern from a holistic standpoint is that this trade has been going on almost the entirety of my career. The Japanese market initially peaked back in 1989, 1990. They started quantitative easing well before the U.S. and everybody else started to think about it. So there's kind of this pervasive, persistent liquidity that's been generated by the Bank of Japan with these ultra low interest rates. And it's really difficult to know exactly how big that is, how leveraged that is, right? In other words, is there leverage on top of leverage? And I think it really reflects a lot more about long-term capital management, which was back in 1998. I was at Lehman Brothers at the time. I actually just showing up to Lehman Brothers at the time. So I remember that very, very well. I think it's a lot more about those types of situations than it is just a regular slowdown. There's an international leverage component to this. And there's a great book by Lowenstein called When Genius Fails, which is all about the long-term capital management crisis. And he's got one line in there, which I've never forgotten. It's a great line, which is, you can be large or you can be leveraged, but you can't be big. And that's 100% true. So the question is, we know this trade is large, right? We know that it's got leverage. The question is how large can people become individually in these trades? I think that's what really stands out. So did we get an oversold condition? Absolutely, we had an oversold condition. Was it the types of oversold conditions that we say, hey, let's get involved in this? It's not, but keep in mind we're still in an uptrend, so the bar is not as high for us as it otherwise has to be in that uptrend. I think the oversold condition has been good for a tactical rally. Obviously, we've seen some of that. I think we can probably squeeze a little bit more out of it. But I don't know, I don't have the confidence to say that we're out of the woods. I'd say it's about 50-50 or it's the lows here. But I think one thing to watch is what happens to the Nikkei. Can the Nikkei go up and break out? If the Nikkei is able to reassert itself in trend, I think that's very, very good news. I think that's, they essentially had a 1987 style crash in Asia. We did not see that, obviously. But I think it's premature to say that the fuse of this this device has fully worked itself out. So we'll continue to monitor that. See 51.91 support for the S&P for us, and obviously with the 10-year deal, 380 is that key level. Right there. Looking at 320. I'm sorry, looking at 415 as the resistance spot on the bounces. So those are big tops. So I think the trajectory of what we're going to see for rates is going to be certainly better as we go forward. Hopefully not too good, because that's an implication of something a little bit more nefarious out there. Neil, what do you have on the docket next week?
Next week's going to be a very busy week. We have, importantly, consumer prices and producer prices. So that'll help us set the table for what the PCE number will be at the end of the month. I think the risks are skewed to the downside for core inflation next week. We also get retail sales. A lot of the things we're seeing out of the earnings reports suggest some softening here in consumption. So I think that's another notable report, the retail sales data that'll be released for July. And look, the markets, all of this got started, remember, after the Fed met, they didn't do anything. Then the data came out and it fueled the chatter that they're behind, because you had a weak ISM, weak jobless claims, and then you had the weak employment report, right? So if the numbers come out weaker this week, in the upcoming week, I think we'll be right back here again, talking about, should the Fed have acted in July? And if people are talking about that, it's just going to fuel the kind of chatter under this idea that the Fed's a little behind the curve, and that's not something that that's not something that is good for risk appetite.
Right. Well, we certainly haven't cleared up the sentiment and the sentiment surveys because it hasn't been long enough, frankly. And we still have this weak seasonality. So part of that's election driven, part of that is just generally there's a seasonal weakness in particularly September in the first portion of October. Steve, what's happening in the Circus Town next week?
Well, two things. One sort of related to what you were talking about. Securities and Exchange Commission, SEC, has some new disclosure tools. Form PF for private fund or hedge funds in particular are supposed to provide information regarding large movements, to put it in very simple terms. That just went into effect in June, which means this will be the first time the commission will see information potentially on the Japanese carry trade that you mentioned. You also have this consolidated audit trail, maybe from that it's broker dealer, in terms of having to provide again, some of the information regarding a lot of the large trades. And where I'm going with this is it's an opportunity to see if these disclosures, now that we're going to see them for the first time, are effective. Are we going to learn any information from them in terms of the SEC? And if so, then I think I'd be concerned from the broker dealers' perspective, because the SEC has been pushing this thing called Reg SCI to provide some additional disclosure requirements and security regarding online access. And there were reports Monday that a lot of customers lost access to their accounts. And I think that's something, if you're SEC Chair Gary Gensler in your remaining time here, potentially with the election, that could maybe move up the priority list. Outside of this, going back to the election, I would watch to see whether or not we hear more from Kamala Harris directly. I think that was sort of the point of the Trump press conference on Thursday, was one, obviously the polls aren't going in his direction. We've seen some rating changes from lean Republican states that were rated that way in Georgia and Arizona, now back to toss-up reflection of the polls, where Harris moving ahead, seeing that now betting markets respond to that too. She's performing a little better than Trump. So looking to do something to get this earned media attention, but also call attention to the fact that Harris has been the nominee, I believe, more or less come Sunday. It'll be 3 weeks since Biden dropped out. She hasn't faced any questions from reporters. I think that was the intent of the press conference. You also saw Trump sort of suggest now that he will participate in at least one debate. He suggested 3. I don't know that Harris will agree to 3 necessarily, but has to do something to maybe try to shift the narrative in the polls back in his direction. So I think that's sort of what I'm watching next week.
Right, serious question. When's the last time Biden made a public statement or was seen publicly?
Well, he recorded an interview that's supposed to air Sunday on CBS. It was earlier in the week, but there's more attention now to the fact that the schedule appears to be lighter than normal, and that's sort of interesting given I think he has a legacy opportunity as he sees it to try to address the situation in the Middle East. And I would think his schedule may be a little more involved, but we don't know what we don't know. And I think the fact that the media has already moved on to Kamala Harris, I don't know that we're ever going to know necessarily what he's doing right now or not doing.
Well, from a market perspective, what we'll be watching is breadth. We had an 87% day yesterday. What that means is that 87% of the Russell 3000 names were advancing. That's a decent number. I mean, we like to see it above 90. You'd be surprised what a big difference 90 is than 87. So, this is not close enough. This is, we need to see those. But getting, another day like that, preferably from a lower level, would certainly be helpful in convincing us that we're starting to see money return back in a wholesale fashion. Important as we look at that historically. The other thing we'll continue to watch is the Nikkei. We'd like to see that break out. We'd like to see that have some signs that there's some returning of the more speculative or at least risk assets there. I think that would be an important and underlooked and underappreciated aspect of whether or not this carry trade contagion is behind us. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. If you'd like deeper insights, join us at RenMacAccess.com. That's RenMacAccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
See you.